Investors rarely pass on a pitch simply because they do not understand the opportunity. More often, they pass because they see risks the business owner has overlooked, minimized, or failed to address. A presentation may appear polished, the market may be attractive, and the financial projections may show considerable potential, but hidden deal breakers can quietly undermine the entire transaction. One of the most common problems is an unclear investment proposition. Investors need to understand exactly how much capital is being requested, what the money will be used for, what they will receive in return, and how they may eventually realize a return on their investment. If the structure is vague or keeps changing during discussions, the opportunity can quickly appear unprepared or excessively risky. Another major concern is unrealistic financial projections. Strong growth is not necessarily a problem, but unsupported growth is. If revenue is projected to increase dramatically without sufficient contracts, customers, production capacity, staffing, or market evidence, investors may begin questioning the credibility of the entire presentation. Ambitious projections must be supported by clear assumptions and a practical execution plan. Investors also look closely at management. A strong opportunity can still be rejected if the leadership team lacks relevant experience, has unclear responsibilities, or depends too heavily on one individual. Investors are not only investing in a product, property, or business plan, they are investing in the people responsible for executing it. Gaps in the management team should be acknowledged, along with a realistic plan for addressing them. A hidden deal breaker may also exist in the company's ownership structure. Too many shareholders, unresolved partner disputes, unusual shareholder rights, excessive founder compensation, or uncertainty about who controls important decisions can make an investment difficult to structure. Even when the underlying business is promising, a complicated capitalization table can create legal, financial, and governance risks. Another warning sign is a lack of meaningful commitment from the owners. Investors want to know what the principals have already contributed, not only financially, but also through time, expertise, intellectual property, guarantees, or other resources. If the founders expect an investor to assume nearly all of the financial risk while they retain most of the benefit and control, the proposal may appear unbalanced. Poor use of funds planning can also weaken a pitch. Saying that the capital will be used for growth expansion or working capital is usually not enough. Investors want a detailed explanation of how the funds will be allocated, what milestones the investment will achieve, how long the capital is expected to last, and what happens if results take longer than anticipated. Legal and regulatory issues are another frequent source of concern. Missing agreements, uncertain ownership of intellectual property, unresolved litigation, incomplete permits, regulatory exposure, tax problems, or outdated corporate records may not be emphasized in the pitch, but they are likely to surface during due diligence. Discovering these matters late in the process can seriously damage trust. Investors may also pass when the proposed valuation is disconnected from the company's current position. Founders often value the business based on its future potential, while investors evaluate what has already been demonstrated. Revenue, assets, contracts, intellectual property, market traction, comparable transactions, and execution risk all influence valuation. A valuation that cannot be reasonably supported may end discussions before meaningful negotiations begin. The absence of a credible exit strategy can create another obstacle. Investors generally need to understand how their investment may eventually generate liquidity. That could involve a strategic sale, a management buyout, a refinancing, a public transaction, distributions from cash flow, or another clearly defined mechanism. An exit does not need to be guaranteed, but it should be realistic and consistent with the business model. Sometimes the hidden problem is not the business, it is the presentation itself. Inconsistent numbers, missing documents, Contradictory explanations, delayed responses, and frequent changes to the transaction can suggest that management is not ready for institutional capital. Investors often interpret disorganization during the funding process as an indication of how the business may be managed after the investment is made. The strongest pitches do not attempt to hide every weakness. They identify the risks directly, explain how those risks will be managed, and present a structure that protects both the company and the investor. Transparency does not eliminate risk, but it builds credibility. Investors are more likely to continue discussions when they believe the management team understands the challenges and has a credible plan to address them. If investors repeatedly pass on your opportunity, the solution may not be to approach more investors. The better strategy may be to step back, examine the transaction from an investor's perspective, identify the hidden deal breakers, and strengthen the opportunity before returning to the market. Equity finance helps businesses and project sponsors evaluate capital readiness, identify transaction risks, structure stronger financing strategies, and prepare opportunities for the capital market. Before presenting your next pitch, contact Equus Capital Finance at www.equusfinance.com.